My next guest is someone who unearths information that the deep state does not want the public to see in the financial and economic world. I believe my next guest, Rob Kirby, is one of the top forensic economic analysts in our world. Rob was born in Halifax, Nova Scotia. He received his post-secondary education at the Great York University in Economics in Toronto. And when Rob finished his degree, he went to work in the financial district, the belly of the beast, if you will, on Bay Street in Toronto. It's the equivalent of Wall Street in New York. He worked on an institutional trading desk. He also worked as an international interdealer broker of foreign exchange and interest rate products. Rob started writing on economic issues in the late 1990s and was involved in a number of entrepreneurial pursuits. He also has written about the markets and, in fact, has written a book from a gold bug's point of view. Bottom line, folks, as I mentioned earlier, Rob Kirby, I believe, is one of the best forensic analysts in our world. His website, Kirby, K-A-R-B-Y, KirbyAnalytics.com. Rob, welcome back to the Operation Freedom platform.
Absolute pleasure to be with you again, Dr. Dave.
So, Rob, there is so much that's not being presented by the bought-off lamestream fake media, CNBS, Fox Business News, Reuters, Bloomberg. When Rob Kirby looks at his radar screen of the economies of around the world and financial issues around the world, what are the one or two top issues that are being, if you will, submerged, blocked by the deep state and the powers that be in the financial world, such as the criminal banking syndicate?
Well, Dave, in my view anyway, the number one issue is that the dollar is combusting in front of our eyes, except it's not being presented to us as combustion of the dollar and our fiat money regime, but that's what it is. And the dollar is being rejected around the world, and it's really no small wonder at all why the dollar is being rejected. America has put sanctions on two of the major crude oil producers in the world, where Venezuela and Iran in particular. And I don't want to hear about politics from anyone about whether I'm not taking a pro-Iran or a pro-Venezuela stance. I'm just stating the fact. These guys have crude oil to sell. China wants crude oil to power their economy, and America has shut Iran and Venezuela out of settlement in dollars. They cannot use the SWIFT system, so dollars are of no use to countries like Iran and Venezuela, not anymore, because they can't transact or settle the dollars. So what's occurred is, necessity being the mother of all inventions. What has happened is these countries have found a workaround, and China is now buying oil from Iran and from Venezuela, and they're paying in cryptocurrency now. And then those countries are taking the cryptocurrency in return and buying the goods and services they need from China. And this has come about entirely because these two countries, rich in natural resources, have been cut off from the dollar settlement system, which is called SWIFT. And as a result, that's what lit the fire, at least in my view, Dave. That's what lit the fire under cryptos back in September. And if anybody can remember back that long ago, in September, the price of gold was $1,900 an ounce, and the price of Bitcoin was around $9,000. And look what's happened since the time, as I would have it, that China has started to do international trade settlement in crypto instead of dollars for oil. Bitcoin has gone from 9,000 to 61,000 yesterday. I think we're currently rated at 60,000. And gold, of course, has gone from 1,900 down to 1,700. So that's what happens. If the people making monetary policy had thought through the situation of imposing sanctions, let's just say the sanctions that have been imposed on those two countries have certainly come back to bite someone on the behind and I don't believe it's China.
So, Rob, many people want to know, well, why are they just using Bitcoin, or if you will, cryptocurrencies, as this method of payment? Why are they not also using, not exclusively, but why aren't they also not using gold and silver?
Well, because gold and silver settle in dollars. So if China buys gold or silver, they're going to pay whoever their most gold trade in the world is settled in dollars. And when China sends dollars back to the miners reinvest the dollars and produce more gold, which trades again in more dollars. It's advantageous, or let's just say it's very positive for the maintenance of the dollar standard to have countries transacting in dollars. And what China really wants to do, at least I believe this, China wants to get away from having their trade settle in dollars. They want to hurt America financially, economically. And they want to do it by excluding dollars from trade. And when you're conducting trade in cryptos, it lights a fire, and because what it does, Dave, is it creates transaction demand for cryptocurrencies, and much the way that trade of crude oil in dollars creates demand for U.S. government debt. And let's just say the auction results in recent auctions of U.S. government debt, foreign participation has been all but non-existent. And I'll just tell you, historically, foreigners have bought a very, very substantial portion of every dollar that America has been auctioning in debt. Foreigners have been buying probably 40 to 50 cents of it for many, many, many years, and that amount has dropped precipitously. So there's no appetite anymore for foreign debt and for U.S. government debt. And despite that, Dave, government in the United States continues to issue record new amounts of new debt, not only rolling over, what's currently on the books, but let's just say it's been an orgy of money printing or money creation. And the inflationary impact of that is being felt in the cryptoverse, in particular. Bitcoin, Ethereum, and other cryptocurrencies have gone ballistically up. Gold and silver have tried to go up, but the advance has been repelled with infinite amounts of contracts being sold on exchanges like the COMEX in New York and the LBMA, London Bullion Market Association in Britain. And the reason we know this, Dave, is because I've got my ear very close to the rail on this. You virtually can't buy physical metal right now in quantity. So the silver market is tighter than I've ever experienced in my life, and gold in size for big institutional players is very, very difficult to procure as well. And that's a complete and utter detachment from the blind, drunken selling that goes on the COMEX exchange. You can't buy a physical ounce in a coin shop or from a mint anywhere, but the price goes down on COMEX, even though you can't buy any in a metal shop anywhere. The price gets tapped and slaughtered on COMEX on a regular basis. This is opposite to what should be occurring, and lo and behold, the cryptos are serving the function formerly that gold and silver performed. And ultimately, there's going to be a breakdown here too, Dave, because this charade can't go on forever where the price is suppressed and there's no physical available anywhere. So it's going to break. Timing,
well, and Rob, there is that theory.
The cryptos will continue to rally.
Right, right. So there's the theory that as cryptos, that many people say, well, it's cryptos versus precious metals. I don't really see it that way. I see cryptos actually leading to a break as it relates to this manipulated gold and silver market, that the cryptos are essentially leading the way And could it be, Rob, that China, that has accumulated huge amounts of gold and silver, that rather than there's going to come a day when China goes, by the way, in addition to you could trade all the gold and silver you want for U.S. dollars, but we're going to open up our own exchange system based on our currency, or based on euros, or based on crypto, or whatever it might be. Do you see that being a potential down in the wind down the line?
Okay, Dave, my view of the way this works out in the future, I am completely of the belief that China is probably the biggest holder of gold in the world, with amounts that they actually hold probably being in the tens of thousands of tons. I believe Russia is probably the number 2 holder of gold in the world, and I think they probably also own tens of thousands of tons, although officially they claim to only own 1,000 or just over 1,000 tons. America claims to have 8,000 tons. I personally don't believe America has virtually any. And I can assure you that China and Russia are never going to sell 1 ounce of gold for dollars. So they may in future sell it for crypto. They may in future sell it for euro. They may sell it for Chinese currency. But if anybody listening to me or can hear my voice, anybody who thinks that China or Russia are ever going to sell gold for dollars in any meaningful way, I think you're sadly mistaken.
So to those folks that are frustrated, that are in the gold and have physical gold and physical silver, and say, well, okay, it's doing better than where it was a year ago. But as Rob said, we were August, September, we were looking pretty good. Now it's backed off a bit. What do you say to those folks, Rob?
Well, I have talked to people over the last 2 or 3 months regarding metal holding, because I've had some very, very close friends who are long-term hard metal people that own metal, and they've actually inquired and asked me whether I thought they should sell their metal and buy crypto assets. And I consistently say to them, if you want more crypto exposure, I would only dedicate new money, but I would never sell any physical metal that I own. And the reason I say it, Dave, is because the time will come when metals will get their turn, and people require patience, and I mean mega patience. And the reason you got to hold them and you don't want to get out of them is because when metals get their turn, I truly don't believe you will be able to buy any. It will be gone. And when the metals take off, which they will, in my view, if you don't own it, you will never get it. And I think that you could get a ride in silver and gold, much like what's occurred in the cryptoverse over the last 9-10 months. So that's what I think is coming, and it does require enormous patience. And but my view on ownership of physical precious metal is stay long and be strong.
And Rob, and folks, we're speaking with Rob Kirby, forensic economist extraordinaire. Kirby, Kirby, KirbyAnalytics.com. Rob, when you look at the big banks, the banksters, in fact, if you and I were, and we were actually at the time in 2011, talking about, let's just pick one, J.P. Morgan Chase. J.P. Morgan Chase in 2010, 2011, they had minimal exposure to physical gold and silver. Would that be a fair statement?
Well, I would say they had less exposure than they do today. Absolutely.
Right. So over the past 10 years, they've actually they've increased their exposure.
Yes, and my view towards J.P. Morgan, Citibank, Goldman Sachs, Morgan Stanley, these people are serial gold shorters. So if you look at the segment of the quarterly derivatives report that is published by the Office of the Comptroller of the Currency, you will note that in the commercial bank category, J.P. Morgan, Citibank, Goldman Sachs, on the commercial bank end of it show as major players, and in those charts, of course, Morgan Stanley doesn't appear at all as being a player in metals, but they are. And the reason I only know that is because a good friend of mine, somebody that I knew for a great many years, used to work in a very senior position in the Treasury at Morgan Stanley, New York, and the person who traded gold at Morgan Stanley, New York, was a very good friend of his, and he told me that Morgan Stanley was categorically number one or number two in the world in gold trading. But it doesn't show up in the quarterly derivatives report because that report shows the activity of commercial banks. And Morgan Stanley trades in the name of a bank holding company. And bank holding companies are the purview of the Federal Reserve, while commercial banks are the purview of the Office of the Controller of the Currency. And the Federal Reserve doesn't share Morgan Stanley's gold trading data with the Office of the Controller of the Currency, so it looks like Morgan Stanley doesn't have a gold trading desk. But they're number one or number two in the world, according to somebody in a very senior position who I happen to be very, very close to. So there you go. We don't really get good numbers from anybody, especially regarding metal. It's kept very confusing, and it's kept in a very convoluted fashion, and the reporting we do get is spotty at best.
Rob, this week we have the Federal Reserve is going to have their little powwow, their little meeting. It's been bantered about that there's going to be some type of either direct mention or tangential mention of something called a yield curve control mechanism. Could you educate our listeners about the significance of that and what it means and the significance of that?
Well, Dave, if there is any legitimate talk about yield curve control, it's only going to be an acknowledgement or a partial acknowledgement of what they've been doing all along. I mean, Dave, last year in Q1, the aggregate derivatives holdings of American financial institutions increased by $40 trillion in notional. The lion's share of that $40 trillion aggregate increase in Q1 of 2020, so that's a $40 trillion increase from Q4 of 2019. We're talking a year ago. So in Q1, they added $40 trillion, most of this being interest rate contracts, and let's just say that the 10-year U.S. government bond last year in Q1 went from a high of 1.80, and at the end of Q1, the 10-year was yielding 60 basis points. So the 10-year yield in 3 months dropped by 120 basis points to the historic lows that we recently were at. And let's just say in Q2 of 20 and in Q3 of 20, the amounts of outstanding aggregate derivatives receded dramatically back from that high water mark in Q1. So there's a direct correlation, whether people want to admit it or not, with the amount of interest rate derivatives that are being traded and yields. And let's just say the drop in 10-year in Q1 from 180 to 60 basis points, if that wasn't yield curve control, it's probably not a good thing to call it as control, because the 10-year yield was thrown off a cliff and forced down with $40 trillion in interest rate derivatives.
Right.
So I guess really to sum it up, yield curve control, they've been using yield and employing yield curve control for the last 20 years. And it gets worse.
It does get worse, not better.
Yes. And you see, and it's that kind of activity, it's that kind of nefarious intervention that has turned the rest of the world off wanting to transact in dollars. It does not let's just say it doesn't make everyone feel warm and fuzzy about holding big amounts of dollars when they know that these kind of shenanigans are being employed and are being instituted by the keepers of the world's reserve currency. It's called, may we please have a new reserve currency. And you know what? And we're going to get a new reserve currency. It's coming.
That's right.
And
Rob,
the
I'd like to
the
thank
wedge
you.
of it right now is manifesting in record and rocketing higher crypto prices. And it will translate into higher prices for virtually everything.
Rob, I'd like to thank you for everything you have done, are doing, and will do. Folks, you can get more information from Rob's great website, Kirby, K-A-R-B-Y, KirbyAnalytics.com.